have a place outside. They have heaters. It's a wonderful environment to have small get-together, and they've done well.
Yeah.
No, I've heard they're terrible, Albert. We do not want anybody else visiting the North Fork.
Oh,
I
okay.
live there now. It is awful. There's, I hear that there's raging COVID. Please, no one else needs to be coming out to the North Fork to go and enjoy the vineyards.
No. Last summer when I went out, a lot of the vineyards had live music and they let you sit outside at tables. You didn't even have to drink from there. You could bring your own food.
It's
and
phenomenal.
everything.
It's really tremendous. It's really a great way to spend the day.
And wait until it gets a little warmer.
So, ladies and gentlemen, Ken Stein, the man who put the Ken in Kensington.
And that's all. Just a little bit. Everything else is Albert and Adam and the entire team.
So what I told Neil prior to you joining is that you sent a memo to use today's session as a training session for the Kensington Associates.
Oh, nice.
That is true. Albert is.
And what is Kensington Associates? What do they do?
Beats me. I'm trying to figure this out. It's about 22 years. One of these days we'll get it right.
Okay. I was giving you the opportunity for a little plug. It's okay.
Albert, it's all you.
No, Ken. Go ahead, Ken. Let's see what you got. I know what I'm gonna do.
I know. I'm gonna wait for Albert to share it. Let others enjoy the time.
Rob, you seeing this? You catching this? This is pretty impressive.
Very impressive.
We're starting a little late because we have people pouring into the room. So I just.
Good morning, all. I'm one of those late arrivals.
Good to see you.
What's going on, Phil?
Nice to be seen.
How you feeling? You feeling all right?
I think I'm over it, but no, not quite.
Oh boy.
I just can't shake this this head cold. I'm afraid it's going to turn into bronchitis or walking pneumonia.
It's not good.
2 courses of antibiotics and steroids.
Oh boy.
What's the next thing? Just stay in bed for a month?
What are you gonna do?
Yep. Just try to take it easy.
All right. Well, we're gonna get started. If people pour in a little late, we'll have to grab them a little late. I want to say happy St. Patrick's Day to everybody. Welcome to another meeting with the LIAFPN, Long Island Accounting and Financial Planning Network. We now stand at about 32 members, paying members. We'd like to be a think tank for those of you in the financial services area. And we're very pleased today to welcome Rob Fishman as our newest board member, who's helping give us governance. I learned that word from Rob. Thank you.
Wait, can do this. Wait, where's the clapping hands?
Yes, he's also a Zoom master.
This is the backwards
If you joined earlier, besides running Sandler training, he's a Zoom master. That's a new title, I think, for Zoom and ours. So if you need help on marketing virtually, Rob is a great guy. And I welcome everybody. Today, we're very fortunate to have Albert Hakim speak about preparing your business for sale. Albert will tell you about his business, which is mergers and acquisitions. And I think you're going to find the presentation entertaining, and you're going to have a lot of questions. Please post them in the chat box, and we'll have time at the end for questions and answers. So with that, Albert, take it away.
Okay, wonderful. So I'm going to share my screen. All right. So just first of all, before I begin, let me just add to what Neil was saying. Rob is also a LinkedIn specialist, and I want to thank Rob for inviting me to speak, and Neil and Larry for inviting me this morning. But Rob is such a specialist on LinkedIn, you can build an entire career around LinkedIn. So if you have the opportunity to connect with Rob and just try to, even if you glean, a little bit of his knowledge on LinkedIn, I can tell you that it's helped me, and he's very willing to share some of what he knows, which is phenomenal. So thank you, Rob.
Thank you, Robert.
My pleasure. So again, good morning to everyone. And I'm used to doing these live and in person, where I can feel the energy from the other side, and I try to keep things interactive. But in this format, as Neil suggested, I'm sure you're going to have a lot of questions. Let's put them in the chat. And what I'll also do is I will put my contact information in the chat. Feel free to reach out to me via email, call me, or by all means, connect with me on LinkedIn. And
Albert, I just muted you. I'm sorry. You have to unmute yourself.
yep,
Thank you.
that's like the old hook that used to come and pull you off stage.
Yeah.
Grab you around the neck. And so I was saying, feel free to connect with me also on LinkedIn. I post a lot of videos. I try to provide a lot of educational content. And if you don't get anything out of the videos, use it instead of melatonin at night. It'll put you right out. So feel free to connect me on that as well. So my presentation, I'm calling my presentation the pandemic edition, because I don't know how you can do a discussion about business and exit, or really just about any discussion today, without acknowledging and understanding the 800-pound gorilla that has happened to us in our lives, which is this pandemic. It's affected everything. You know, and the majority of the people on this call are professionals. I mean, you've seen it. It's day to day. It seems like it's never ending. And thank goodness there's some light at the end of the tunnel. Thank goodness that people are starting to feel optimistic. And I also, thank goodness, if we're mainly on Long Island, that we are on Long Island. You know, just when you get into this, the comparison between what's going on here and what happened to the city, New York City, it's still mind-boggling. So I'm going to address some of that as we go through this presentation. We've also hand-selected some case studies, some real examples of things we're dealing with right now, which are relevant, not just in terms of COVID terms, but as it relates to business, as it relates to valuation, as it relates to all of this stuff. And one last thing before I really get going is let's recognize that this is a big subject. You know, I could do an entire session on any segment of this, whether it's valuation, whether it's increasing your value, whether it's financing, whether it's understanding buyers and their motives, mistakes. So what I'm going to try to do is I want to provide a lot of value. I'm going to try to touch on a bunch of things, try to keep it interesting. I'll pause strategically at some point and, you know, maybe open it up to see Neil is going to monitor questions in the chat. But by all means, we're going to end it early. And I know I'm not going to get through the whole thing because we want to open it up to questions. And I encourage the interaction. Challenge me, guys, because that's how, you know, good stuff comes out. So here we go. It's still all about planning. If you plan, that has not changed. More than likely, your outcome will be better than if you didn't plan. It's like that saying, if you think about it, it'll materialize. If you put it top of mind, it'll happen. It's all about planning. All right. So I am Albert Hakim, and I am an entrepreneur and business owner for north of 30 years. I cut my teeth in multi-unit retail, high-ticket items. I was in national mail order. I was in wholesale and distribution, and I was in consulting, technology. So I've had quite a broad career. And I was in a change situation. I was not happy with where I was in my business. And I went to my friend, Ken Stein, who I knew kind of did this business thing. And I've sold businesses before on my own. I was never enamored with the process. And I said, what do you have for me? And I'm not going to go into that story because that would take, you know, the entire time. But suffice it to say, I joined the company about 10 years ago. And I think the key to my success has been my background, just my ability to speak business with business owners and really understand what they're going through. My son is applying to business schools, as I mentioned to Neil earlier, and I tried to have this conversation with him about how you really don't know unless you have to meet a payroll or you have to juggle your payables because you can't pay everyone at the same time. And you really don't understand a business owner's pain unless you come from that world. So not only do I come from that world, I'm still a business owner. I own a cookie distribution business, and I am living these pandemic issues and some of what's going on a day-to-day basis, along with every other business owner that's out there that's living these realities. So I feel that it helps to keep me genuine and humble in this regard. Who is Kensington? Very quickly, we primarily focus on mergers and acquisitions for the last 20 years. We sell private companies of all kinds, and we also sell networks of established franchises of all kinds across the country. We also help a lot of buyers looking to get into business, whether they're looking to take on a side hustle or they want to make a change. And we are FranNet of Long Island, and we represent 180 national franchise brands. What separates us from many other professionals who do what we do is that we have certain tools that we use to assess candidates, and we can use those tools towards guiding them to a new franchise, if that's appropriate, or we can use them to help guide and inform to an existing business, if cash flow is important. And we use all of those tools because our goal is the success of the client. We don't sell a thing. We try to find the best solution for a particular problem. We also do franchise development. Some brands you might have heard of, Hot and Stone Massage, Chocolate Works, a company called Fountain, and currently we're franchising Long Island Bagel Cafes and trying to increase their footprint regionally and nationally. And we also do business valuations. So very quickly, there really are only 4 exit strategies for a particular business owner. You can hand it down to the family. The data is showing more and more that the children do not want dad's business or mom's business. You can hand it to the employees or sell it to the employees. There are certain structures like an ESOP. You can sell to an outsider. That's where we step in, and I'll educate you about that. Or you can just shut it down, close it up. I can speak for an hour just on this because in COVID, this has become a specialty, right? The ability to get out of your lease, the ability to do something with that debt, the ability to not take on more debt and shut down. Oh my God, things that are going on. But again, I know I'm addressing many professionals here, so I'm not going to spend time on this. All right. We have a wonderful woman who works in our office. Her name is Lauren. She put some of the beauty to these slides together. And I asked her to put up a slide about COVID, and you'll notice the people in the masks. But what struck me about this image, you see people headed in different directions. If I'm going to impart a lesson from what we've seen through COVID, it's exactly that. It doesn't affect any 2 people the same. Everyone is going in a different direction. There are certain people who have done phenomenally well through COVID. There are certain sectors that have been absolutely decimated, and everything in between. And take your valuation playbook, if you will, and just throw it out the window, because everything has changed. And yet, as you're going to see, I asked the question, has everything changed? The answer is yes, but not how you might think. So many things have stayed the same. To begin with, let's recognize that business never stopped. I mean, if you look at what happened, especially on Long Island and tri-state area, even though we were shut down for a couple of months, supermarkets, essential businesses, service businesses, technology, telecom, think about all of the things that you needed to use even when you were hunkered down in your home or wherever you were hunkered down and being socially distant. Nothing changed. But there are certain realities. So on the bright side of the ledger, we still have unbelievably inexpensive money out there, historically low interest rates, and an abundance of capital. Let me repeat this. The amount of money that's out there looking for deals and looking for situations is really amazing. you would have thought that given the pandemic, it would have dried up. But we're finding that's not the case. And in addition to the amount of money that's out there, you know, and I can talk about where that money is later if people want me to. The government incentives, the PPP money, the idle money that's out there has really been a lifesaver to so many businesses, and not just a lifesaver to allow them to sustain. I picked an example where I'm going to show you how it turned the fortunes around for one company in just a minute. The other thing that I've seen in this pandemic, it's given people an opportunity to take a breath, take a pause, and hit the reset button. What do they want to accomplish? So maybe business owners who were teetering or were you know, really on the fence. Should I sell? What do I want to do? You know, COVID has given them an opportunity to reassess. So, well, maybe now is the time to get out. And if the flip side is true, maybe now is the time to grow. Maybe now is the time to double down. So in many senses, you know, COVID has been positive from that perspective to get people to focus on what's important and what do they want? What are their objectives? I can tell you deals are getting done. You would think that in this environment that things would not be happening. And that was true in March and April of 2020, when we didn't know if the world was going to survive. The pipeline dried up. Nobody was doing transactions because it was too scary. But by the summertime, June, July, August, I can tell you we have been as busy as ever. And what's surprising to me, and hopefully it's interesting to the people listening, are who is active. I would have thought that the most active groups would have been strategics, and strategics are, you know, business owners in a certain area looking to gain market share and grow through acquisition. But I'm finding, or my perception, it's maybe a little bit more than perception, is it's really the private sector and the family office world. The people with money who have money to deploy and want to make a change. I get so many calls a week from buyers who want to get out of their corporate world, or maybe they see the writing on the wall, or maybe they just have time on their hands and they want to do something else. So we have a lot of private money chasing deals, as well as family office money. And if you want me, I'll get into a discussion about what's a family office, what's a private equity company, but we can do that later if we have time and if the group wants us to. The other thing COVID has done is it's literally put a spotlight on those businesses who have proven themselves resilient. So if you did well through COVID, even if you didn't do well through COVID and you only suffered a little bit, but you sustained, you're very attractive, incredibly attractive to the market. So the fact that your 2020 numbers are not as strong as your 2019 numbers, again, depending, really doesn't make all that much difference. A lot of the money is still chasing you. So that's what I would tell you is on the bright side. And let's not spend too much time on the not so bright. I think we all kind of get it. There are sectors that have been decimated. I mean, some retail sectors, you know, the hospitality world, catering, even though that's beginning to come back now. It's really it's sobering to have to talk to these business owners and try to guide them through what's been going on. Part of it is a lack of predictability. You know, the government has no idea when things are coming back. The state changes its guidance every week. You know, we just don't know. You know, nobody can tell a business owner when things are getting back to normal, really getting back to normal. So that creates a lot of anxiety. We're hearing all kinds of employment issues. We're competing with unemployment insurance. It's hard to find talent. It's hard to retain talent. They can stay home and earn as much money in many cases. There are increased costs businesses are incurring for safety protocols, for protection, for everything related to being able to operate in a pandemic. And the fear is not just domestically, it's globally. I don't want to get into all of the delays that happen, importing from overseas, China, containers being stuck. There's all kinds of anxiety, delay, fear related directly to the pandemic on every level. And as we transition from a pandemic to an endemic, which is something we're probably going to be living with for many years, figuring out how to do business causes anxiety. And this is what we're seeing. I'm moving on. Neil, how are we doing? Any questions so far?
Everything's good.
Okay,
Doing great.
So we selected several case studies that we hope you guys find interesting, fascinating, and insightful. And since this is a session about how to prepare your business and what to think about, we're going to start with valuation. So I want to show you what the difference a year makes in a couple of examples. So this is an owner who owns 9 fast food franchises in the greater New England area. And the next slide, just to show you what's coming, this same owner happens to own 14 fast casual units as well. The difference between fast food and fast casual is fast food is very small footprint, really no seating, it's structured for takeout and delivery, versus fast casual where you might take the family, have sit down, you have waiter service, wait service, and so on. Also the difference is relatively inexpensive to build versus very costly, large, costly units to build. So in 2019, and I hope people can see my mouse here, this chain, this 9-unit chain had 12,600,000 in revenue, as you could see here. In 2020, they increased their revenue in the fast food segment by almost $2 million. Why? People were ordering, people were eating or ordering out, nobody's dining in. So those who happen to be in this space generally saw an increase. But what really happened, and this is what I think you're going to find interesting, is that they embraced the notion of third-party delivery and third-party drivers. So if you look over here, they used to deliver locally, internally, and it was 8%, their costs were 8% of their revenue. And with the embrace of third-party drivers, they increased their cost to 12%. But look what they were able to do to their revenue. They were able to have less internal people on payroll, more 1099 people on payroll. And when you look at what happened to the bottom line because of that, and let's just look at this number for a second, because this is what really drives value in the majority of the businesses that we're involved with. They had earnings or EBITDA of 9% to their gross in 2019 and 15% to their gross in 2020. That's an increase of almost 90% to the bottom line from 2019 to 2020. And you could see where they picked up that difference. They picked it up in a little bit of savings on the cost of food. They picked it up in lower payroll costs because they went with more 1099 workers. And plus now their rent, because their revenue went up, is a lower percentage of revenue. So let's look at valuation. All right, everybody with me so far? Neil, nod, I'm looking at you. Okay, so in 2019, if you want to take a 3 times multiple, and this is how things are valued, a multiple of a certain number. So if you take a multiple of earnings, which is the general way things are valued, this business would have been valued at 3.48 million. If you look at a 4 times or a 5 times, you see what the value of the company might have been in 2019. If you look at 2020 numbers, 3 times is just thrown out the window. When, you know, with 2.2 million in earnings, we don't need 3 times earnings. We're going to get much higher values. Look at 4 times, look at 5 times, look at 6 times. And it's not unreasonable that somebody might pay 6 times earnings on a business like this. And just to keep it a little interactive, Neil, if you will, Anybody want to take a guess as to why a business like this might capture this large of an earnings valuation? Can we throw that out there?
Somebody- You can unmute yourself if you have a.
Anybody want to take a guess? 3, 2,
Growth expectations.
good guess. Anybody else? Okay.
Industry.
Did I hear something?
The industry.
That's right, Adam.
Industry.
You can't mistake Adam's voice. So the answer is, it's because of the space. It's because the market values this space. The market is telling you, and really in valuation, the market speaks. The business is only going to sell for what the market ultimately will pay for it. The market is telling you that this model is really what the future is probably going to look like. So it's worth a little bit more because we can see the future in this model. More people will continue to order in, especially as technology gets better and more of these delivery services happen. And I would argue that the second reason is I can own this business. Rob Fishman can own this business. I can't own the next business, the fast casual, because I'm not a food operator. I don't know what I'm doing, but I could possibly run this. So if I'm looking at a long-term strategy investment, I could see myself jumping into something like this and getting a return on my investment that would blow away what I can invest in the market in this. So let's move on. Same owner, same kind of geography, Greater New England, also owns 14 fast casual franchises. These franchise units are large, very expensive to build, $1 million plus kind of to build these units, and very popular pre-pandemic. So if you look at 2019, the chain did nearly 15 million in revenue, and then they got clobbered with COVID. 2020 is less than 12 million, 11.7. That's $3 million less. That's 21% less. By all accounts, you would say, okay, 20% adjustment is not bad in this environment. But look what happened to their bottom line. They went from 11% earnings, EBITDA, of gross to 3%. Why? Because to operate these larger fast casual units, how much staff can you reduce? How many cooks can you reduce? How much wait staff can you reduce? You simply cannot operate these units in kind of a hunkered down positioning, plus the rents, plus all of those other expenses that go along with it. Insurance, Neil, they're not giving up their insurance even in pandemic. So the contrast here is startling insofar as what the market might value these units. So let's go right down to the valuation. And I lost my mouse. There it is. So in 2019, we weren't thinking about a 3 times valuation because a chain like this commands more. The market will pay more. So you could look at what a 4 to 7 times multiple of that earnings would look like. And just again, for information purposes, the cost to duplicate these 14 units is probably in the order of about $10 million. They're very expensive to build. So let's look at 2020. With 370,000 in earnings, a 3 times multiple is back on the table. Oh, how sweet. And if you look at 4, 5, 6 times, an 8 times multiple, we're barely getting to $3 million. So they took a significant hit here. And just so you know, I gave you the answer right next to it here. The market is telling this business owner that they're valuing this 14 unit fast casual chain at $3 million. So you look at this, an investment of 10 million, we're lucky we might get 3 million for it. The previous one, the market, if you wanted to know where the market was telling us where the value is, the market is valuing this chain at $10 million. What a reversal of fortunes. So let's keep it interesting. Let's show you the combined network. So let's not feel too bad for this business owner. If you look at the combined numbers of 2019 and 2020 for both chains, that's 23 units. We have roughly 27 million in sales, which is consistent. And we have roughly, north of 2.5 million in earnings, which coincidentally is about 10% of sales. It's very interesting. So, and you can see the difference between 2019 and 2020. So in the end, you've got about this much money in terms of cost to duplicate. These were some of the summaries of the combined valuations of where this thing might sell. I call this the reality check. The reality check is typical seller wants to sell the fast food franchise, of course, based on the 2020 numbers, is doing great, but wants to sell the fast casual chain based on the 2019 numbers. Have we ever seen this from a client wanting to get it both ways? So the seller wants to get $21 million for his chain. The market is telling him that, look, might get 13 million. The reality is that our job is to help bridge that gap and help explain really the reasons why and what the reality is. This seller wants to sell, and we may do better than 13 million because of the fast food franchise and the market's willingness to pay much more for that. So there will be hopefully a happy ending to this story. Do we want to pause here for questions before I launch into the next case study? Neil, do we have anything in the chat?
We don't have anything in the chat box. You just keep going.
Okay,
Good.
So let's keep going. So I put this one in for because I want to show the love to the accountants in the room. We're going to talk about balance sheet. Don't they get excited? All right. So we have an importer or distributor of luxury items, and you guys can see clearly the two sides of the balance sheet, 2019 versus 2020. I'm not even going to talk about revenues and earnings in this slide. This is the difference balance sheet makes in valuation, which is sometimes too often overlooked. So it's just in terms of background, I think you should know, and I have it here in the slides, that this was in contract pre-COVID at $850,000, including their inventory. Their inventory at the time was in the neighborhood of $395,000. The pandemic hits, and by June, sales are off by 75%. The deal falls apart. Nobody's going to go consummate a transaction when the target company is off by 75%. So what happens? The seller pivots a little bit, but he also gets a little bit lucky. So the first thing he does is he hires a phenomenal Amazon person, and he pivots towards a strategy of trying to sell his luxury goods in the business to consumer side versus the business to business side, which is where he was traditionally based. So by doing that, sales start to come back. He's getting a nice result on Amazon. And more importantly, the margins on his sales are higher because he's selling directly to the consumer. So you combine that with the luck that the government came in and provided all of this money and incentives. And what he was able to do was reduce his debt, which was strangling him. So if you look at the debt on this side, you've got very heavy debt to factors. I hope everyone knows what a factor is. And you have heavy debt to the bank, and you have ridiculous interest rates on credit card debt. And he was being strangled by that debt. In fact, if he sold in 2019 for $850,000, he would have had to pay all of this debt back, which would have netted him maybe half of those proceeds, maybe less. because he would have to pay that debt back. Fast forward to 2020, between taking some idle loans at very low interest rate and PPP money, he was able to get rid of that debt completely. His debt is now to one loan or a couple of loans where instead of 24% interest rate, he's paying 3.75% interest rate. He reduced his overall debt by around $300,000. And moreover, we're in contract today at $1 million. So you say, okay, well, that's a great story. Maybe it's not a huge deal, but let me just point something out to you. If he sold at $850,000 back then versus selling now at $1 million, it's only about $150,000 difference. So we have an extra $150,000. We have less overall debt by about almost $200,000. So he's keeping that as well. And those PPP loans that are still out there are likely to be forgiven, and he's going to be keeping that. So by my quick math, by doing this deal at $1 million, which is only $150,000 difference from the deal that he had in place a year ago, he's keeping $420,000 more than he did in the first deal. Beautiful story. A story about how balance sheet affected valuation and a happy outcome. Customer concentration, one of my favorite subjects. If a business is concentrated too heavily in certain client or amount of clients, or too heavily with certain vendors, or too heavily reliant on certain employees, it reduces their value. So I have a real life story that's happening as we speak of a telecom company where the largest client represents 50% of their earnings, 50% of their revenue, and their largest vendor, the provider of the service, represents 60% of their revenue. The sellers had a certain number in mind because the market really does reward this notion of recurring revenue. If you are able to build some level of recurring revenue into a business, whether that's a subscription-based revenue, a membership-based, or if you take my favorite example is an alarm company, the monitoring that you pay every month, those businesses get rewarded very handsomely. Why? The predictability of the revenue. We know exactly how much money is coming in 2019, 2020, 2021, and that's not changing unless they royally screw it up and you change providers. But that generally doesn't happen all that often. There's not that much churn in those businesses. Those businesses get rewarded sometimes with multiples of 10 to 15 to 20 times earnings. It's staggering, but because of that predictability in the revenue, that's what happens. So this business had that predictability in the revenue, but was too concentrated in their client base and their vendor base. This was not that easy, but we found a buyer ultimately that, because of a synergistic business, is able to take the revenue from this company and should be able to leverage it across a couple of their other platforms and actually cross-sell and upsell in both directions, both to their base and to this company's base, and get a return on investment much faster than other companies would. And then it took some compromise, both on the seller side and on the buyer's side, but we're in contract right now. This should close in March. Happy ending, another COVID story that you could not have predicted. I'm moving on. How am I doing, Neil?
Larry Shearer has a question. Larry, you want to unmute?
Yeah. In a situation where you're heavily dependent on maybe one or two vendors for purchasing all your product, wouldn't a vertical integration strategy be the way out? I mean, basically market to the vendors?
So it generally would. And in many cases, that's the answer, Larry. In some cases, depends on the size of the company, in some cases, these vertical buyers are too focused on risk, and they want to pay less than someone else who, one, needs the business and can leverage that business across all platforms. So, there's another situation I'm involved in right now that I didn't put up here on the slide, but the vertical would pay about a 2x multiple. We found a buyer at a 4x multiple, non-vertical. So you're right from the perspective of integration. Will they value the business? Will they give you the multiple that the sellers are looking for? That's a challenge.
I guess it depends on how dependent the vendors are on the supply chain.
It's very accurate, and it also changes relative to the size of the business. If we're talking about a $50 million business, your buyer is vertical, right? Because that's, there's no question about it. If you're talking about a $1 to $2 million business, again, me and Rob are buying all these businesses, we can own it, and so we might pay a little bit more because we want it. Rob, I'm just continue to put you on the spot, which I love doing, sorry.
Thank you, Albert.
Okay, so let's, I'm a believer of telling both sides of the story. So I have to tell you this story, even though I don't like it, but I'm going to breeze through it and I don't want to spend too much time on it. This is a story about waiting too long. We have a 75-year-old owner, has built a beautiful company that serves a real purpose in a needed market. But he does everything. He's always done everything. That's the way he built the company. When I got involved with this owner, he showed me an offer that he received 5 years ago, and I read it. It not only, as the slide says, was in an offer at $3 million, it would have given him a salary of $500,000 for the next 3 years. He didn't take it. He thought the company was worth more. As the gentleman aged, the business changed, sales went down. When I got involved, we started marketing this company at $1.5 million pre-COVID. In February, I got an offer at $1 million for the business. Gentleman turned it down, thought the company was worth more. It's very hard to separate the emotional part of a business owner's business from the business. Very, very difficult. And I should get a degree in psychology, because that's really what we're dealing with. We're dealing with emotions. So the sad part here is that COVID seriously affected his business. The business sold into school districts, and many of the school districts didn't have any funding. They were closed, so they couldn't buy the products. And only last month, the gentleman was diagnosed with kidney failure, has to go on dialysis. Bottom line, the only exit here is he's handing the business to his key employee, and he's going to hope for some kind of an earnout if this guy is successful. Simply waited too long. So that's one of my lessons. If you plan, hopefully you don't wait too long. All right. So what's my message to business owners? Is get your professionals involved. Don't wait. That's why they're there. All right. You get Larry involved, you get Neil involved, you get me involved. Get involved early. I've been doing this for 10 years. And for 9 years, I've been out there saying, hey, Mr. Business Owner, get to me a little bit before you have to sell. Get to your CPAs before you have to sell, and tell them that you're thinking, maybe 5 years out, 3 years out. Why? One, we know what your goals are, right? 2, we can map out a strategy to get there. 3, you can actually do simple things that will make you much more attractive to the market. And this is where business owners don't focus. I guarantee you, ask 100 business owners, who is the likely buyer of your business? They don't have an answer because they don't know. Now, no fault of their own, they just don't know. So get your professionals involved, give yourself enough time, plan it out. And my slides probably support this right here. There's an inverse relationship between time and price. If you're out of time, it's gonna hurt you on the pricing side. If we have time to really market and really go out there and try to identify the right people, you'll do better on the exit. Don't assume the business has no value. You'd be surprised how many business owners I speak to that think they just, it's time to shut it down, and there's value there. They don't realize what's valuable to certain other buyers out there and groups. And don't assume your business has unlimited value. It's measured. Figure it out. If you have the facts, I have full confidence in business owners. You're going to make good decisions. So, as I mentioned, I had businesses. I've sold businesses. I probably have left more money on the table than I would venture to say most people on this call. And very simply, because I was a young hotshot doing my thing, killing it with growing revenue, didn't give a hoot about expenses and earnings. And nobody spoke to me about the relationships between revenues and earnings. So no one ever had a conversation with me about growing my business versus growing the value of my business. My understanding was, if I'm doing $2 million, I grow it to $5 million, I'm much more valuable because I'm selling for $5 million. Where in my reality, it was the reverse that actually happened. And then the real question, you're building this inventory, you're building this business, how do you get your money out? How in the world, when you built this monstrosity, which is what I did, I had a very big company with a lot of inventory, high turnover, who in the world, how can you get your money out? And that's what I suffered from. I did not understand the relationship between expenses and inventory. And I could not see, because again, I didn't have the proper people around me. I couldn't see how you sustain the growth. To sustain the pace that I was on, the way I was doing it, required way too much capital. And never understood the impact of accounts receivable, accounts payable, and inventory on my value. So these are just some of the lessons I've learned which have humbled me, and I share these with my professionals and my business clients. This is one of my favorite slides. Nobody plans to do this. It just seems to happen. You get business owners get stuck. You ask them how, they don't even know. They might not even be able to you. So I think I want to stop here because I'm looking at the time. I just want people to know that this presentation continues all about who the buyers are, what are they looking for, what are the sellers looking for, what is the process, why we need to think about our exit, how you can grow the value of your company, and mistakes. So I'm going to stop right now, and I'm going to open it up to questions, and I'm also going to put all my contact information into the chat. And I encourage anyone to reach out to me by email, text, follow me on LinkedIn. I'm happy to continue the conversation.
Hey, Albert, Rob here. Great job, first of all. Can you talk a little bit about the sellability score?
So sure. So that was a slide that I glossed over. As I mentioned, we have certain tools. And this one tool, which I happen to be very fond of, it's called the sellability score. Written by a guy named Rob Warlow. And Steve Davies uses a lot of his stuff. He wrote a book called, Building to Sell, and he's written many business books, but he actually invested the time and money to go out there and measure companies who have sold and prepare a bunch of questions surrounding the attributes of those companies that sold, what they sold for, how much they sold for, what the value was. And basically he synthesized it down to 8 drivers of a stronger multiple. And they include valuation and cash flow and positioning and customer satisfaction. So I have this tool that I send to business owners that, just for the sake of the group here, we make available at no charge to anyone who wants to use it, where a business owner can simply take their temperature. It lets them answer those questions, and it gives them a score on a scale of 0 to 100, so they could see where they score relative to other business owners who have sold. And it's real data and it's real kind of, you know, back of the napkin valuation, but it's, well, I use it as a conversation starter because it shows me that a business owner at least has started to think about it. And that's what we want. It starts with thinking and then, you know, it gets into more tangible stuff. Any other questions?
I just wanted to point out the worst time to sell is when you have to.
Yes.
And that was a great point, Albert. Worst time to sell is when you have to. And with impending tax changes, with estate taxes coming into play, if you're intending to leave your business or your clients or to their family, leaving it to them in a tax efficient manner is extremely important and requires pre-planning, whether it's insurance or something else. You have to be mindful of any estate tax, gift tax, and this should be brought up in a conversation, not just on the value, but what's the net to everybody, and to make
Yeah.
sure it's equitable and fair to family members and everything else.
And Neil, while you're on that, you might want to just mention, because we have some business owners, I believe, online. I think you should really touch on the impact of some of that tax planning, because we're talking significant dollars. You know, people always focus on what will I, you know, can I get 3 million, 4 million, 5 million? The question is, how much can I keep?
Correct. Well, you know, Larry Shear can vouch for that. You know, we're not sure where the estate taxes are going, but we could give you a million instances. A lot of people have a lot of property and they want their son to manage the property. And maybe the property is worth, maybe it's an apartment building, it's worth about $10 million. Well, if that gets taxed up to 40, 50%, how are they going to manage that building unless they sell it?
Yep.
It's not liquid. So people have to be liquid in cash. And Larry, you can add to that. It's a real issue.
The very first estate plan I worked on, I was still an accountant at the time. The guy controlled almost $7 billion worth of real estate in the early 80s. And they brought in the attorney who had handled the John Paul Getty estate. And the gentleman had to explain to him, you have to sell everything you own to pay the tax on everything you own. You've done no planning. You're 83 years old and in bad health. And they really, other than giving it to charities, there was no exit strategy that was going to work well. So planning early and looking at the tax code. Of course, we have big changes now. I think if you look at the news today, Biden said that he's going to try and raise another $1 trillion a year in the taxes for the American people. That's a big leave on the table for people who aren't planning.
Unbelievable. Anybody else?
Hey, Albert, this was a great presentation. Natalia Zimnach here. Neil, I would find it valuable if maybe you scheduled another one of these in the coming weeks or in the next couple months, just to finish off the rest of those slides, because I think that's really important for us as collaborators with, you know, your company, is to know what to look for and what some of the key signs that maybe clients of ours don't necessarily verbalize with us, and something that we can bring up with them, you know, like, hey, Mr. Client, Mrs. Client, you know, it looks like you're, you know, I get the feeling you might want to, you know, you're considering selling your business. So I think that would be really valuable if you could, you know, maybe do another presentation and wrap up those slides. And yeah.
Well, so you know, this is being recorded, and we're going to send this out to everybody after the presentation, so you could follow along. So
That's wonderful.
Well.
So Natalia, first of all, very nice meeting you. And what do you do, if I can ask?
Yeah, I'm a financial advisor.
So I finally successfully put my contact information in the chat. Please connect with me. First, you know, if I don't get the opportunity to do this in the near future in this forum, I'm happy to share the information with you. And, you know, it's this kind of forum is difficult because, you know, once we get to talking about where you specialize, you know, because I can structure the information for your purposes. So happy to connect with you offline as well.
Great, thank you.
Hi, this is Frank. Can I raise a quick question that sort of reflects off of what Natalia just said?
Sure.
Because when you sped through those slides, I saw the stuff that I was eager to hear. For a business owner that's on that point of the spectrum that you laid out of, my business isn't really worth anything, why should I bother?
Mm-hmm.
What is the work that can be done to assess whether there's any value to the market in the first place before you go and do all the other work that you need to do in order to be able to sell?
So Frank, you and I need to talk. That this is exactly what you can do is speak to your professionals. That's what you can do. So you connect with your accountant to get a real understanding of where you are. I speak to you and I'll give you a sense of the marketplace. And you're not, again, I'm not going to charge you for that conversation. I'm happily, in my view of things, it's better if I tell you after I looked at your business that we're not going anywhere, Frank. Your best option is to shut it down than for me to waste your time and my time and all of the professionals with trying to do something that's not realistic. So I'll give you a good sense of this. By the time we're done, you're going to know if there really is anything that can be done.
Okay, I'll follow up. Appreciate that.
Thank you.
Well, thank you, Albert. We're going to head off because I know a lot of people have meetings to go to. I thank everybody for their time. Please, LIAFPN.org. If you're not a member, one of the valuable things that we do as membership is we make introductions, and we make a lot of them. So becoming a member, all these things we don't charge, but part of being a member is making valuable introductions to quality people that can help you in your business. So thanks again for all coming. And again,
Thank
happy
you,
St.
Neil,
Pat's.
Larry, Rob. Very much appreciated. Thank you, everyone.
Thank you. Great job, Albert.
Thank you.
Good job, guys. Thanks.